Welcome to Inside the Deal. I'm Suzanne Stevens. With me today is Dominick DeChiara. Dom heads the PE group at Nixon Peabody. Dom, we're here to talk about alternative deal structures, but before we get to that, based on what you're hearing from clients and your own work volume, what's your best take on deal volume and how it's changed over the last 9 months, 12 months,
Sure.
18 months?
Well, deal volume has definitely slowed down across the board. The pace of deals has slowed, the number of deals has slowed, and from what I'm hearing from investment banks, there are really not going to be any new deals for some time until the first quarter.
And what about your private equity clients? Is volume different based on the size of the client or their area of investing?
Yeah, the bigger clients are having a hard time doing deals right now. The financing is obviously an issue. The smaller deals and the smaller clients are still in business and are still doing deals.
Well, we certainly know that private equity groups in particular are out there raising money. I mean, they have been raising money. There's been a lot of money raised over the last couple of years. Do you expect a surge in M&A once financing becomes available again?
Sure. I think once credit loosens up a little bit, you'll see the private equity guys be creative, find alternative ways to deploy their capital, because at the end of the day, a fund does not really want to give the money back to the LPs. They'll find ways to invest it and invest it in good investments.
Right. I mean, that's what they're there for. That's what they're there for. When do you think that might happen? When do you think they might be back in the market?
It's really difficult to tell right now. My best guess would be third, fourth quarter 2009.
Well, as you mentioned, there are some deals that are getting done, and those that are doing deals are doing them creatively. And one of the kind of alternative deal structures that you've seen an increase in is the use of seller notes.
Sure.
How so?
Well, the one thing that I've heard from my clients and other folks that I talk to in the industry is, with credit being so difficult to find, they've been going back to sellers saying, listen, we can't finance these deals on these terms today. Let's give you a seller note, and if down the road we can take it out in the future, we will.
So when financing returns, that's a case where the deal might be restructured.
It might be restructured at that point. Of course, you're going to have to get the senior lenders to play along at that point, and depending on where things stand in the overall credit cycle, if you will, they may or may not play.
Do you think senior lenders, though, might be more apt to play because of the market that we're coming out of?
Yeah, I think they
might.
Does
that encourage them in some way?
Yeah, I think so, because I believe that the capital structures being put in place today are more conservative, and the multiples being paid are lower than they were in the past.
Another deal mechanism that we've seen over the years is earnouts,
Sure.
But you say you're seeing an increase in the use of those as well.
Definitely a lot more earnouts are being discussed and implemented in transactions, and whenever you have an earnout, there's a lot of negotiations that go on around it. There are a certain number of issues that you see time and time again. What are you going to peg the earnout to? EBITDA, revenues, et cetera. Most private equity funds are going to tie it to EBITDA. And then the question is it a 1 year, 2 year, 3 year payment cycle? And do you look back in case you miss it in year one but have a great year in year two? And then there's just a whole host of issues that come out of that. And they're difficult to negotiate because at a certain time in the deal, the sellers are giving up control of the company, yet part of their purchase price is dependent on how the company performs. So there's just a tension between the buyer and the seller. But I will tell you, most private equity funds that I work with really want to see the sellers make their earnouts, because then it's a very successful investment for them.
Right, it's good for everyone.
It's good for everybody.
That's the goal of the earnout. Rollover percentages are another structure that you're seeing. What exactly do you mean by rollover percentage?
What I'm talking about there is we're seeing increased percentages of rollover equity being required of the sellers. So in the past, you might have a seller only rolling over 10 or 15% of their equity. Now those percentages are increasing to 20, 25, 30%, even more on deals. And that's, in my opinion, directly attributed to the fact that credit is difficult to come by. So again, with less coming in from the debt side, they have to find creative ways to finance it.
Dom DeChiara with Nixon Peabody, thanks so much for coming in.
Thanks for having me.
I'm Suzanne Stevens. Thanks for watching Inside the Deal.